The shocking future of oil prices revealed. Is oil worth $120,000 a barrel? I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's talk about the past price of oil. We're going to do exactly what Jim Rogers has taught us to do by pulling up a chart and asking ourselves why a commodity or a price of anything has spiked in the past. If you don't know what I'm talking about, we'll put a link to my interview with Jim Rogers himself in the description below. But let's start with a chart going back to 1950 all the way to 2000. On the left, we go from $20 a barrel all the way up to $160. Please keep in mind this is adjusted for inflation. 1950, about $30 a barrel, goes down to about $20 a barrel in 1970, and then it really goes parabolic from 1970 to 1980 all the way up to almost $120. Then it goes on a 20-year bear market from around 1979, 1980 all the way to 1998, where it got under $20 a barrel. It goes up a bit. We have the dot-com bust, 9/11, and then it goes parabolic again, up over $160 a barrel, adjusted for inflation. It collapses during the GFC, goes up a bit 2010-11, but then comes all the way down. We know what happened recently with the cerveza sickness, below $20 a barrel again. So what can we learn from this chart? The first thing I noticed is oil tends to go in these 20-year or 10-year cycles. Goes down for about 20 years, then up for 10 years. And you can see that indicated by the red and green arrows beneath the chart. And the catalyst for a bull market in oil always seems to be some sort of geopolitical event in the Middle East. And let me be clear, I'm not saying the future is going to look exactly like the past, but what I am saying is we need to analyze the past, look for catalysts so we can better determine what the probabilities of oil going up or down in the future. Also wanted to point out, in the bull market between 2000 and call it 2011 or 12, you had a huge boom in emerging markets, a lot of demand for oil and commodities in general. And going back to geopolitics just for a moment, if you look at the past 2 bull markets in oil, there always seems to be consistent instability. But my biggest takeaway from this chart is in the past where we've seen big moves in oil upward, you've seen a stock market or an asset bubble come crashing down. In the 1970s, 72 to 74, the stock market went down by over 60%. Most people don't remember that. In 2000, 2001, we had the dot-com bust, and then 2008-9, we have the GFC where the stock market went down by 50%. To understand why this happens, let's go right to the internet. The 2000s commodities boom was created following the collapse of the mid-2000s housing bubble. Commodities were seen as a safe bet after the bubble economy surrounding housing prices had gone from boom to bust in several Western nations, including the UK, US, Ireland, Greece, Spain. Advisors claim that commodity prices could be better predicted than stocks since they're traded for actual usage and the price is based on supply and demand, while stocks are bought for speculation and news immediately influence prices. Sounds very similar to what's happening today. We have these huge asset bubbles that could be collapsing in on themselves. Will people move to commodities because they see them as safer, something tangible that's in the real economy, and they want nothing to do with these financial assets that have been created by the Fed, quantitative easing, funny money, and financial engineering? That we'll have to explore in the rest of the video. Step number 2, we've discussed the price of oil. Now let's talk about the cost to get the oil out of the ground. We've got a chart going back to 1970 all the way to 2014, but I've taken it to 2020. More on that in a moment. On the left, we have the price of oil, $0 a barrel, all the way up to $120 a barrel. In 1970, extremely expensive to produce a barrel of oil, almost $100. It goes up and down and up and down. In 1980, goes back to near $100. One thing I want to point out here, in 1970, the price of oil all the way down under $20 a barrel, adjusted for inflation. So is it any surprise that the price of oil went through the roof? From 1980 all the way to the mid-90s, the production costs plummet till we get to near $20 a barrel. They spike back up. Then in 1998, again, we have a huge discrepancy between the cost around $60 a barrel and the price under $20 a barrel again. But in 2014, we have the exact opposite. The cost still around $60 a barrel, but the price was up over $100 a barrel. And this is when we're having a speculative mania in the stock market because the Fed has dropped interest rates all the way down to zero for almost a decade. The banks see all this money being made in the oil space, so what do? They throw money at anyone producing oil they could find. They want to get in on the oil boom. This creates too much supply and prices came crashing down to under $30 a barrel where we saw them in 2016. But I also want to point out that this chart shows the average cost to produce a barrel of oil. It's actually all over the map. Editor, go ahead and throw up a chart of the costs per country to produce a barrel of oil. And it doesn't just fluctuate from country to country. It really depends on how they get the oil. Look at Russia. Arctic cost them $120 a barrel, where onshore only costs them $18. Wow, you can see how dramatic the difference is. Starting at Russia with the Arctic at $120, going all the way down to the UAE at $7 a barrel. Look at the United States, where the deep water, $57 a barrel, but shale at $73 a barrel. You can just imagine what's happening to those shale producers now when oil's plummeted due to the cerveza sickness. And speaking of the cerveza sickness, look at where we are today. Again, the price of oil drops below $20 a barrel, while the cost to produce it on average is $60 a barrel, just like it was at the bottom of the bear market in 1998 and in 1970. Step number 3, we've discussed the price of oil, the cost of oil. Now let's talk about the value. And this is where we're going to figure out what prices in the future will most likely do. And it starts with the quote we all know well from Oscar Wilde. I've changed it up a bit, but you get the gist of it here. A fool knows the price of everything and the value of nothing. So what is the value of oil? Is it $120,000 per barrel? To find out, let's go to a clip from my recent interview with one of the leading experts in the oil space in the entire world, Art Berman.
A barrel of oil, if you convert it to kilocalories or some other form of energy, and do all the calculation for how many days a week do I work, and et cetera, works out to be about 4.5 years of human labor in a barrel of oil. Now that's a huge bang for the buck.
Right.
So a really important point that most people don't think about is what's the difference between price, cost, and value. And most of us use those kind of interchangeably, but let's talk about a barrel of oil. So the price of a barrel of oil today is about $25, roughly. The cost of a barrel of oil, which is what does it cost to actually get it out of the ground, is about $60 a barrel. The value of a barrel of oil is the work that it contains. So if we say that the median income of an American worker is $26,000 a year, then the value of a barrel of oil is like $120,000.
Right.
So these three things, price, cost, and value, are very, very different. And you cannot find any other source of energy that's got a multiple of, like $25 price to $120,000 value. And that's why energy is the economy and oil is the most productive form of energy. Therefore, money is nothing more than a claim on oil when you get right down to it, or some other form of less productive energy. So when I hear people talk about, oh, well, we're going to go to an all renewable economy, hey, I'm all for it. But let's understand that the bang for your buck, the energy density of solar or wind, is a fraction of oil. The value of a unit of energy produced from solar or wind is, like maybe 10% of what's in a barrel of oil. So if you're good with that, if you're willing to run a society that has 90% lower productivity, if you want to think about it that way, that's just great. Let's do it. But it's going to be a poor world, a very poor world on 100% renewables.
So to better understand exactly what Art is talking about, let's go back to the example of the real economy. This is the United States. On the right, we have a farmer that produces cows, corn, and cotton. They produce so much stuff that it allows other people in the economy to do things like being a doctor, manufacturer, or a construction worker because they don't have to produce their own food or cotton for their clothing. So, as a result of the productivity of the individuals on the right and the individuals on the left, for that matter, the entire society gets richer. And as each individual is more productive, it allows others in the society to do things that weren't being done before. If you look at an example of the United States back in the 1800s or the 1700s, every single person was a farmer. You didn't have a choice. You had to grow your own food because very few people could grow more than they need to consume. But all of a sudden, you have people growing a lot more food. It allows the economy to expand. But Art points out the reason we're so productive is because oil is such a dense source of energy. It all starts with oil. Without it, the people on the right or the left couldn't be near as productive. They couldn't produce as much stuff, goods and services. Let's say there's another option for energy, an option B that's 90% less dense than oil. That means the productivity, the amount of goods and services we could produce in the economy would also go down by 90%. Well, let's just think this through. If you watched my interview with Jim Bianco the other day, you know that during the GFC, our output of the entire economy went from 100% down to 94%. Think of how much pain we experienced, and that was just a drop of 6%. To give you even more context, in the Great Depression, the economy went from 100% down to 74%. Well, what would happen to today's society, the quality of life, the standard of living, if we went from 100% all the way down to 10%? I don't care how green it is. I don't care how bad oil is. There's no way as a society we would be willing to go down to that level. It's just too much of a cost. So what's going to happen to the price of oil in the future? Well, there's definitely going to be a bid for at least the next 20 to 30 years when we look at what the damage would be to the real economy if we move to an alternative source of energy, especially if the value of oil is $120,000 a barrel. That's for sure. But also, let's go back to step number 1, where we talked about these bull markets in oil having a lot to do with asset bubbles deflating or crashing. People don't want anything to do with financial assets. That includes stocks, bonds, and housing. So what do? What have they done in the past? They've looked to commodities just like oil. But let's take it a step further. Let's get outside of the box and think about how negative interest rates might affect the price of oil. This, I think, could be a game changer that nobody is talking about. Check it out. Right now, China produces a lot of the stuff we consume in the United States. We know that well. So in return for the stuff, we give them dollars. Well, China takes those dollars, goes straight to your insolvent Uncle Sam, who is always drunk, that's for sure, and he is spending money like a drunk sailor. So he is producing plenty of treasuries for China to buy with the dollars we give them for the stuff they produce that we can consume. So China keeps these treasuries instead of dollars. Well, this is really a dollar-denominated asset that they need because they have a peg to the dollar. So they always need US dollars. That's a completely separate video, but you've got to remember that for the sake of this example. So they're buying an asset that's denominated in dollars and they're getting a little bit of a return, an interest rate. But what happens if interest rates go negative? Now all of a sudden they have a negative carry. It actually costs them money to hold the asset denominated in US dollars. So they would be better just holding on to the cash itself, but then they might be worried about inflation. So what could they do in the future if this plays out? Well, they could buy oil. It's denominated in US dollars, but instead of just being a piece of paper or a claim to your drunk insolvent Uncle Sam, it has a lot of use. They can use it domestically. They can use it to grow and expand, whether you like it or not. Whatever they're doing in Africa and South America, it all requires a lot of oil. And especially now that the cost of oil is $60 a barrel and the price is only $30 a barrel. It's a total no-brainer. So if we combine all the factors together, the price is a lot lower than the cost. We could see all of these asset bubbles come crashing down, so people are driven to buy something that's tangible, something they can use in the real economy, like commodities and oil. And you get negative interest rates, which prompts all of these other countries outside of the United States that need dollars, that typically buy treasuries. Now all of a sudden, it's a lot smarter decision for them to buy oil. You have all these demand components coming together at once, which will definitely drive the price of oil over its production cost at $60. It could take it to $100, $200, who knows how high the price of oil can go, especially if the value of oil is $120,000 a barrel. For more content on negative interest rates and the price of oil that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.